So a private mortgage then is very simply a mortgage that's advanced by a private lender. But when we get into the characteristics of a private mortgage, that's where it gets a little bit more detailed. So generally speaking, we're looking at mortgages when we talk about private mortgages that the majority are second mortgages. That doesn't mean that there aren't a lot of first private mortgages being done, because there are, but generally speaking, you're going to find the major characteristic of a private mortgage in the entire industry is a second mortgage. They're all uninsured. Equity, it's being used for equity takeouts. They tend to be a higher interest rate. They're higher risk. They're non-amortized, and they have shorter terms, as well as there's smaller loan amounts. And we generally speaking, we're looking at security-based lending with higher fees. So we talk about this a little bit more. Some of these points are self-explanatory, but when we get into points 4 and 5, there's a higher interest rate because there is higher risk. Those 2 points, along with point 9, security-based lending, tend to be important when we're talking about the characteristics of a private mortgage. Why? Because first off, a lot of individuals who aren't sophisticated when it comes to lending in the private mortgage space have an erroneous opinion that mortgages, because they're secured by real property, houses, real estate, that they're insulated from risk. And that's simply not the case. The fact is that there are a lot of risks that we'll be talking about later on. Again, this is just an introduction, like an overview. But there are a lot of risks involved in mortgage lending. That's why we're here. From a regulatory standpoint, regulators tend not to get involved in situations or sectors of an industry that are humming along with no problems. With the exception of OSFI, the Office of the Superintendent of Financial Institutions, they tend to look forward and then stick their fingers in the bank's business. I don't mean that negatively, sounds like it, but they look forward, they try to see trends, and then they tell the banks to tighten up or whatever they want the banks to do, like's been happening over the last couple of years. But most regulators don't. Most regulators will take a look at what's coming, but they'll really focus on what's happened already. And in the past, there have been syndicated mortgages, and we'll talk about those, that have caused a lot of issues when it comes to investing and lending in mortgages. So those who may think that investing in a mortgage is safe and secure are not understanding risks associated with investing in mortgages. Those who do understand that set interest rates appropriately. So you could be an individual who comes to a mortgage broker thinking that, this is fantastic, I'm going to get 14% on a second mortgage, and it's a safe investment. Why isn't everybody doing this? And it's up to us to educate the individual that you're going to get a high rate of return, understanding that high rates of return are directly associated with the risk. You might not think there's any risk, but there is. And that's when we're going to be talking about risk disclosure this week and the different forms of risks. But there are definitely risks involved in investing or lending on mortgages. So that's where the higher interest rates come. With the non-amortized, it's interest only. That tends to be to make the payment more palatable for the borrower. And the shorter term is another point that I'd like to talk about. When it comes to short terms, that's also a trend in the industry, which we'll be talking about shortly. But we do short terms in private lending generally speaking, because it's higher risk and nobody has a fully functioning crystal ball that I know of. Some think they do, but it's interesting. I was looking at some headlines this morning, and one real estate association said that housing prices in Toronto are set to increase in 2023. And then the Financial Post had an article that housing prices in Toronto were set to continue to decline in 2023. So you know what, whatever side of whatever point of an issue you can take, there are people there who will have those opinions. So nobody has a fully functioning crystal ball. We all tend to have crystal balls that we think we're reading right. But because we don't know where the market's going, one of the great ways to mitigate risk is to do shorter term. So think of it this way: if you're looking out over the horizon, what's in your direct field of vision, you can see much more clearly than you can further away. And that's the same thing that we think about when we talk about the length of the term. I have a much better understanding, and my crystal ball is much clearer when I'm looking in the next 6 to 12 months. Now, that doesn't mean that things can't happen that are completely unexpected. But if I were doing a 5-year term, what are the odds that I could probably accurately foresee what's going to be happening over the next 5 years, like in years 3, 4, 5? I don't know where interest rates are going. I don't know where the market's going. But in the short term, at least I have more data to make an educated guess on. That way I can protect myself. So if I think interest rates might be going up and the market might be leveling off, values might be leveling off, values might be decreasing a bit, I have ways now that I can protect myself. If I was looking over the 5-year period and was thinking to myself, yeah, you know what, if this was a few years ago, yeah, over the next 5 years, rates are probably in the industry stay really low, housing values are going very high. That's where you get a little overconfident, and then you start making decisions on lending, maybe more aggressive loan to values. And in that particular case, you get a little bit more aggressive on the loan to value, and then something unforeseen happens. COVID comes along, the end of COVID comes along, changes the outlook, inflation is going crazy. We don't see that coming. And then housing values start to drop. So the 85 or 90% loan to value given out by a lender a few years ago, if they did a 5-year term, thinking that in 3 to 5 years, the value would be increasing, so their loan to value would be decreasing. Now their loan to value has increased, so the security, the equity in the property is decreased because of what's happened in the market. Therefore, short-term lending reduces or mitigates some of the risks for private investors and lenders. That's why we tend to see short terms. And that doesn't mean that there's not an option to renew. It doesn't mean that you have to charge a large fee when you're renewing. What that means is that you have the option to get out as an exit strategy before things turn.